Hi everyone, how are you? Welcome to this live event. As usual, we will be sharing with you a few minutes to take a look at what the market can give us today and the following days and see what we should care about from technical and fundamental point of view, right? Anyway, I will start by sharing the calendar. I was really hoping that this week bring a bit more of definitions for the euro particularly. And so far, so good, right, guys? We have nothing new going on in the euro. We have a higher high today, a couple of pips above the previous, but still uh, nothing to see in there. We're stuck around 114. Uh, and I was really hoping this Chinese data, we have plenty of Chinese data this week, can tell us whether the market is feeling risk averse or want to buy back high yielders or whatever, right? But the stocks are not doing much. Also, we are not seeing fresh lows, fresh highs. We are not seeing too much action across the financial world. And I do believe that there's a lot of uncertainty going on not only about the Fed this time, but also about Brexit, which I still believe pound self was extreme. And I still believe that the risk of a Brexit is limited, whatever the referendum says. But anyway, the market is uncertain. The uncertainty rules the market, and we have no clues on what to do next and where to go, and we are not willing to go too far away. One thing that remains, of course, is strength. I do believe that the risk in there is pretty strong. But anyway, let's take a look at the data we had today and how the market is reacting to it and what we could expect for the upcoming hours and days, right? Earlier today, we have the inflation in Germany. It was a revision, right? It was a preliminary reading, and this revision matched that one. Still depressed, still poor inflation growth in the first largest economy of the euro area, which means that the upload of quantitative easing that Draghi launched in March is still not giving us too much to work with, right? It's not producing a big effect. The positive surprise this morning was the uptick in UK inflation, right? Core CPI yearly basis, it's up to 1.5%. It's a really nice number because the core reading, it's usually the most important, and it's approaching the 2% target of the central bank, right? So that's why the pound is reacting positively to this news. Still, if you take a look at the monthly reading and the yearly reading, the uptake has been shallow, and still there's a long way to go. But at least it's positive and should support the pound, particularly in this dollar weakness environment, right? Anyway, and for later today, we have a couple of Fed speakers. I have filtered the calendar and I put the more relevant, so we are not seeing it. But we are going to see, I do believe, at least three first speaker. This Hacker, Williams, and one more I can't remember at the moment. But the three of them are well-known hawks, right? That means that they are going to offer us a hawkish rhetoric, although I don't believe that will be enough to give the greenback a boost, right? Enough to change the ongoing trade. Anyway, during the upcoming Asian session, Chinese trade balance will bring some light over the Australian dollar, and therefore could affect the rest of the currency as if the data is positive. We see particularly an increase in exports and imports, right? That will mean that will mean that the Chinese economy is starting to recover, or that the economic slowdown is easing at least, and therefore should still market sentiment improve. That will mean there will be higher stocks and probably a weaker greenback across the board, right? The Bank of Canada will be offering its latest economic policy decision also this Wednesday. Guys, the Bank of Canada has been pretty hawkish lately, well beyond market expectations, right? And that has been underpinning the Canadian dollar alongside with the comeback in oil prices. Don't forget this weekend we have the meeting in Doha, right? The meeting of oil producers. Supposedly they are meeting to discuss the possibility of an oil production freeze at January levels. I'm pretty sure they won't reach an agreement, you know, but so far that kind of news is supportive of the oil and therefore of the Canadian dollar. Anyway, if the Bank of Canada offers a hawkish tone as expected, right, and rates are expected to remain unchanged, that will probably boost not only the Canadian dollar but also other commodity related currencies just such as the New Zealand and the Australian dollar, right? And that will weigh on the greenback again. So I'm still seeing a doomed future for the poor greenback, right? I do believe that if the dollar rises, it would be more as corrective rather than a new turn, which I do believe we are still far. Anyway, on Thursday, we have Australian employment readings. It's usually a big market mover, and again, will affect only the commodity related block. Uh, I do believe that we are expecting a soft number for March, April, uh, for March, sorry. So that could affect the block, sorry, and see the greenback gain some ground. But again, I do believe that those movements will probably be seen by the market as selling opportunities. The European inflation figures are expected to be really interesting this month. I believe that it's a bit over exaggerated at 1.2%, but if we have inflation of rising this much, uh, that will mean the euro area is finally starting to recovery, and probably will also mean that the ECB won't add much more easing, right? That will imply that local share markets can retreat partially but not plummet, and therefore, if local share markets fall, the euro may rise, right? Not only because of the good data, but because of the intercorrelation with local share markets, okay? For the Bank of England, honestly, ever since they started with the Super Thursdays when they announced everything, rates, monetary policy, minutes, right? Remember a year ago, minutes were released 2 weeks after the meeting. Well, the fact is that the Super Thursdays have the bill for the pound, and they have become pretty much no events. We are seeing them pretty dovish. Uh, I don't expect any change in the vote, right? They will keep rates lower for longer at this point. And with Brexit fears around, I don't believe the market will pay too much attention to the to a neutral Bank of England. U.S. inflation, on the other hand, can bring up do a bit more noise on Thursday. Yet, um, it's still too early to tell. One swallow doesn't make a summer, and I do believe that a positive inflation reading in the U.S. can actually help the greenback. We will need, I don't know, maybe 2 or 3 months of growing inflation in the U.S. Sorry, to boost hopes of a rate hike, right? And therefore, uh, that will be the only reason the dollar can rise. Uh, uh, I was thinking that the Fed last week released the minutes of the latest meeting where they say that has been discussing an April rate hike. Of course, we are not expecting the Fed to move this month. I do believe that they will meet next week. Uh, but the thing is that they will they keep on thinking that they will rise rates sometime this year, right? But chances are very limited until September, and unless they give us a surprise in June with I don't expect much from them in the upcoming month. Okay, uh, the week will end, sorry, with a strong number of good readings in China again. So retail sales, industrial production, and GDP growth, right? 7% is the magical number in here. I'm not sure what market is expecting, but GDP has been falling 6.8. It's a low number. We need a 7.0% or something above this level to feel confidence between investors, among investors, and see strong risk appetite rise. Okay. Okay. Let me share my charts for a second. Let me try. And we go to the interesting part of the day, which are charts, at least for me. Okay, here we are. I don't know how many times I've said 1460 over the past 2 weeks. I do believe plenty of. This is the euro dollar weekly chart, and as you can see, with one single exception, 1460 level has been keeping on the pair limited since late June 2015, late January 2015. The level is a major resistance level, and today we tested for third time in less than a week, because we tested yesterday and I believe on Thursday, and still the price was rejected from this huge level. Technically, there's nothing giving us a close on direction in here, because ever since the pair has been trading between 1330 and this 1460 for over a week already, right? Technical readings have turned flat, and we need to take out on that range. We need to move away from that range. I still believe that the euro is bullish due to dollar's weakness, but we really need to clear that level, that region, to trigger an upward move. 1 pip above it is not enough. Maybe 10 pips above it, maybe 1470 is the level where stops are. And once triggered would mean a sharper, steeper advance in the pair, right? I was thinking earlier today that the fact that the pair has been rejected from levels so many times lately may discourage partially bulls, right? So we may see a downward corrective movement, but we need to break at least below 1240, 1250, right? That region, to talk about a bearish movement. If we decline down to that level, I could take it as a corrective movement. I still believe that market will attempt to buy at lower levels, but as I was saying, if bull gets discouraged and the pair breaks below the base of the range, we can see a 100 pips downward corrective move that won't really affect the dominant trend. And back to the weekly chart, if somehow we break that 1460 and settle above 15, I'm looking for a test of the 17 region, because we have the 100 moving average there in the weekly, and we have that high from last August at 1713. Anyway, there's not much to add in here. It's terrible when a pair enters a so tight range. And in here we have two options: either play the range or wait for a clear breakout of it. And so far I don't see much of a reason for a breakout. Maybe US inflation could be the reason. Okay, the pound has recovered, right, and advanced beyond last week high. Take a look at the weekly chart, right? It completely reversed its latest losses, and it seems to have entered a consolidative stage. And I don't believe the pair can break below 140, which is the major support, ahead of the referendum, which will take place on June 26, right? If I'm not wrong, by the end of June. Anyway, the short-term picture for the pound is not bullish, not only because positive inflation, but also because dollar weakness. So I'm looking for a test of or a break above 43.70, right? Take a look at this neat static resistance level to see the pair extending its rally up to this highs in the 44.50-60 price zone. Okay, the line in the sand in the short term, and for me, is the 200 exponential moving average around 42.40. as I do believe that if a price breaks back below this level, the bullish case will be denied. The pair will probably return towards the lows in the 41, 40, 50 region. I still see strong buying interest ready in between 40 and yes and 40, 50 to defend the key critical support level I was mentioning a few minutes ago. But anyway, bullish in the pound right now. Oh, it's bullish. No hopes in for the greenback right now. Uh, this is the Australian dollar daily chart, and as you can see, the 23.6% retracement of this year rally has contained the downside once more. We have that level around 75.15. Pair has been as low as 74.70, right? But quickly bounced back. So that's for me the line in the sand in this one, 74.70, right? That's the level I would be watching for. And I do believe that declines down to that level will continue to attract buying interest. Okay, we need to break down below it to see a deeper corrective movement, probably towards this Fibonacci area where we have also a couple of highs, relevant highs, 73.80. Right there, we have a nice room to trade if, in the case the pair falls. And on the other hand, I do believe that we are still bullish in here, and with metals rising and stocks struggling to gain, not actually gaining today, but struggling to gain, the risk remains towards the upside. Remember, we have on Thursday employment data, but I don't see much relevant figures to be released during the upcoming Asian session on Australia, so that should keep the upside favored, right? Unless all of a sudden the Fed rises rates today. Anyway, short term, the immediate resistance comes at 76.80, ahead of these highs around 77.20. Sorry, I do believe that if we take that high and settle above that level, we can go up to 78 and beyond up to 0.80. The Reserve Bank of Australia is beginning to express concerns about Aussie strength. It's not really comfortable with the Aussie rising. They would like it better, closer to 70 than to 80, right? Something below 75 will be great for them. Uh, but you know how the market reacts to central banks owning, right? Usually, the market tends to ignore whatever the central bank says and do as it wants. To be honest, Australian economy is the one performing the best this day, so there's not much chances of a downward move in here, right? Any move towards downside should be triggered by dollar strength, and these days we have none. Take a look at gold nearing the year high, crude at about 40 stable. So generally speaking, there's no much of a case to go against this trend. The dollar Japanese yen has bottomed twice around 107.60. Okay, but the bounce has been shallower the second time, which tells me that the risk remains towards downside. It's true. Bank of Japan Governor Kuroda has warned a couple of times that they will intervene or extend easing if required. But to be honest, those kind of interventions could trigger. I remember the first one a couple of years ago, or a bit more than a couple of years, which triggered a 300 pips rally towards the upside. Let me see if I can. Okay, when the pair was back on its days in here, right, around multiple lows. Probably this was the first intervention, which triggered a 300 rally in a day. The second intervention triggered 150, and the third intervention triggered none. When the market is in a trend, it takes more than a central bank intervention to actually revert the trend. And of course, well, the trend reverts that far away, 2011. I do believe I'm talking about more than a couple of years. But anyway, whatever product may say or may do, right, could probably be short-lived, right? The market reaction could probably be short-lived. We may have a 200, 300 pips rally, but at this point, and it seems way too far away. This region in between 1450 and 15, right? It's a line in the sun in here. And as long as we remain below that level, bears will maintain control over the dollar term exchange. I still believe that if we can go lower, my main bearish target comes at 106.20, right? And there were some comments coming from policymakers last week that the Bank of Japan could tolerate the dollar Japanese yen exchange down to 105, right? Or up to 105, sorry. So I have the feeling that the market will try to push towards that level some time during the upcoming weeks. Still shorter term, but let's go to the shorter term, the interesting one. The pair has been struggling above 108 so far. We have a couple of downward moves below the level 107.90. I do believe it's the immediate support down towards 106.760, sorry, lows. So if we take those two, we can go down to 107, particularly on negative US data, right? If we have a negative US macroeconomic release, the pair tends to accelerate towards the downside if it's positive towards the upside. And on the other hand, we have an immediate short-term resistance around 108.40.80, and I do believe that above it we can go up to this high set late last week around 109.10, but we need to recover this one to correct as much as up to 110. Okay, but still seems too far away. Sometimes 200 pips in another Japanese yen seems like a lifetime. Okay, back to oil. Take a look at this chart. This was the latest bullish rally. The commodity fell down to the 61.8, right? And then bounced back, and it's about to challenge this year highs. I know not every chart, not every broker offers the same price, so maybe my eyes and your eyes are not the same at the time. So I will hardly advise you to take a look at your charts and look for those highs. For me, in US futures are near 42. Okay, if we take that level, we can go up to 45. I don't believe we're going to see such strong movement ahead of a weekend meeting between OPEC and non-OPEC oil producers, but we can go higher, right? It seems that we finally have set an interim bottom in here. Yet, if the meeting goes wrong and they don't come to any kind of arrangement, we can see the commodity back towards 35. I believe that 35 should now be the line in the sun. We are not going to go anywhere near that 25 we've seen early February, but down to 35 it's still possible, okay? And the highest I can see it right now it's 50. About 49.20 has been a major resistance level. So if somehow the rally extends next week with after the meeting, the highest I can see the price is 150. It's 50, sorry. Then some consolidation will come along and not much more. And gold, we have seen quite choppy price action lately, but all of a sudden the commodity is recovering. In spite, we are not in a risk aversion environment, which means that all of these latest gains are being triggered by pure molar weakness, right? And I still believe that's strong. The buying interest is strong and leads the way. So dips are seen as buying opportunities. I'm waiting for a break above this high for me around 1271. Sorry, yes, 71. To go and retest the heights around 83.50. Okay. If we take this one, we can go up to 1300 this week, but I'm not sure if speculative interest will be enough to push it further higher. Still believing that gold depends purely on the Fed, and as long as the Fed denies a sooner rate hike, gold will keep on rallying. If somehow yes, data becomes ultra positive this month and next month, and we start to suspect or believe that the Fed may act in June, I could expect a deeper downward corrective movement in year strong downward move down to 1150. Okay. Uh, Again, I don't trade gold or oil, but I take a look at them because they are telling me what market strength is and how the currencies react. Strong, strong commodity prices are usually supportive of course, the OC and the CAD, but they also do a lot for the euro and the pound. Oil is quite correlated with pound, while gold has a correlation with the euro. Okay. Anyway, I believe that's all, folks. That's all, folks. Okay, that's it for today, guys. Thank you for being here with me, and see you back soon. Okay, bye bye.